The bad news is if the property doesn't do well, you owe the full amount plus interest. But the good news, the other side of that coin, is if you absolutely hit a grand slam and crush it, you don't owe them the upside. You just owe them what you guys agreed to. There's a chance that the property does really bad and you guys both lose your money that you have invested into the deal. And that does happen, and it's something that is part of this business. Welcome to episode 2 of our Raising Private Capital series, perhaps the most important series that we're going to cover in this podcast. We're going to talk about raising private capital a lot, but to start with, I'm going to do a 3-part series. If you haven't, check out part 1 on the deal triangle. This is part 2, and we're going to get into the nuts and bolts of how we actually fund our style deals in this episode. And in the 3rd episode, we're going to talk about how to go out and actually have conversations with potential capital partners. But today is all going to be about how we fund our deals and explaining the basics of how that works. So we're going to take my very first deal that I did as the example for this episode. So we bought 2 20,000 square foot office buildings back in COVID times, and our purchase price was $850,000. We also, at the time, thought we needed a rehab budget of $150,000. So if you're out there doing math at home, that's $1 million of hard costs. And of course, we were going to have closing costs, et cetera, et cetera. So what did we do? We went and got a loan, and it ended up covering, the initial loan was for $650,000. So we had $200 to cover on the down payment. And then the extra, we thought, rehab budget of $150,000. And so that's $350,000. If you listen to the last episode, what other categories should we have included? We were new, so I wasn't as thorough as I am now. But we had closing costs from the lenders and the title company. We already talked about rehab costs, and we had pursuit costs, getting environmental surveys and those things done. And in a perfect world, we should have built in a reserve, and we should have built in a fee for ourselves because we spent a lot of time going and funding that property. We did none of those things because that was our first deal. We just got the deal done. So you guys are already going to be way ahead of the game compared to we were. But just to show you how it's possible, and we talked about the myth last time, if you need a lot of money to do commercial real estate, certainly money helps. And we had to have money for pursuit costs to go do environmental surveys and those different things. We had to have money for an earnest money deposit on the property. But by the time we got to the closing table, we had our primary loan, and we had secured 2 private money lenders who became partners with us, who helped us fund the deal. So at the closing table, we had overwired money to the closing attorney, who wrote us a check for, I believe, $150,000 that we then went and did the rehab with. So at that initial point in time, we had none of our own money in the deal. Now, we eventually had money in the deal later for reasons I can get into and have gone into in many other podcasts, primarily around needing a fire sprinkler system that was not in our budget. But up front, we had none of our own money in the deal. So yes, sometimes you'll hear me say, you can get into commercial real estate with none of your own money. And that is true. Like I keep saying, though, having some money helps. And it's not industry standard to get into these deals with none of your own money. Your capital partners, and we'll talk about this, like for you to have some skin in the game, and you should have some skin in the game. You are going to have plenty of skin in the game when you do these deals. But you can absolutely buy commercial properties with not a lot of your own money, and sometimes none. So we're going to talk about all the different ins and outs of how we do that today. So last episode, we talked about senior debt. Funding a deal. We are almost always getting some kind of senior debt, primary debt, whatever you want to call it. We talked about these last time, but just a real quick hitter again. We are getting 3 types of funding. Most commonly, a local regional bank is providing us a DSCR loan based on the stabilized rent of the building. That's one option, and that's typically for your more stabilized buildings. What does that mean? Buildings that already have tenants in place and cash flowing. Another way that we buy buildings that are either vacant or less stabilized is through bridge loans. And those are higher interest rates loan. They're typically interest only for a few years with the goal of refinancing into a more permanent debt product like a DSCR loan after you get the building stabilized. And the last way outside of private money is seller financing. We love seller financing. Ask all your sellers about seller financing every single time. So we got that out of the way. That is typically 75 to 80% of the funding. What we are going to spend the majority of the time talking about today is what we call the equity layer of these commercial deals. And we talked about this a little bit last episode, but there's several key fundamental parts of the equity layer. There's your down payment, there's your closing cost, there's your pursuit costs, environmental surveys, regular surveys, appraisals, those things. There is your closing cost and your rehab budget or your construction. So How do we fund those things? So we do something we call the LLC Partnership Method. And this is a fancy term for partnership, right? And so we invite capital partners to invest alongside of us in our deals. For that in exchange of investment, they get an ownership percentage of the LLC that owns the building or owns the project. For every single deal that we do, we spin up a fresh LLC. So everything is separate. All of our deals are separate LLCs, separate ownership structures, separate books, separate bank accounts, and they file separate taxes every single year. Our accountant loves us or hates us. I'm not really sure which, probably both at any given time. Sorry if you're listening, Michael, but I know probably hate me right now, but in a couple months, you'll love me. So that's how we do it. There's terms in this world you need to understand. Those are GPs and LPs, general partners and limited partners. So the operators, the people doing the work, are called general partners in this business, and they handle the day-to-day. There could be one general partner, there could be multiple, there could be two, there could be three. It doesn't matter. It's up to you. Then there's limited partners. Those are the folks with the money, the capital partners. So they are investing their money into your deal with the goal of mostly being a passive investor. And the classic example people think of is busy high net worth individuals. We'll talk about the different kinds of people that invest in these deals with us. But if you think classic, you've got dentist, doctor, lawyers, folks like that have very busy careers who are working 40, 50, 60-hour weeks, and they're making money. They don't know where to invest it, or maybe they're putting some money in stocks and want to do something a little different and try this. So we offer opportunities to folks like that. And they're a limited partner, which means they don't have to handle any of the day-to-day operations and decision-making. So there's GPs and LPs, general partners, limited partners. If you're bringing capital to the table, typically you want a limited partner role. And I give them silly examples when explaining this of like, hey, I know you don't want to hear from Sally, the tenant in unit 1A, who is going to be late on her rent this month because the 5th hit on Sunday and Friday was a bank holiday because of July 4th. So her money's going to be on the 7th. She's going to come in on the 7th, but she's going to pay the late fee. Like, I hope the capital partners, limited partners don't want to hear that, because that's what we're here for. And then, honestly, I don't even want to hear that. The property manager should hear that and then update us on the rent collection. But you get the idea. We should be managing the day-to-day, and I use a silly example of that to explain how their role fits in this organization. Now, one of the things that we do, and we'll talk a lot about communication, is we aspire to communicate extremely well with our LPs, with our capital partners. So everyone is a percent owner member of the LLC that buys the building, and what we tell those capital partners is you share in the profit or loss of the project. So if we buy a $2 million building and we sell it for $4 million, they get to participate in the major upside of that building. Heaven forbid we lose money, their original investment is definitely at risk. This is an equity investment that we are selling. And by the way, we are selling a security. This is subject to SEC rules, which we'll talk about at the end. This is not a debt. If they invest $100,000 with us, that money is at risk. The good news is they are not at risk for more than that money. We as general partners typically are, because a lot of times every time when we're doing a local regional bank loan with the DSCR product, I am signing as a general partner a personal guarantee that we will perform on that loan. So the other things that I have are at risk because of that personal guarantee. The limited partners do not sign that. I would never ask, and my banks never ask limited partners to sign a personal guarantee. So their original investment is at risk, but nothing more than that is the good part. Obviously, because equity deals are higher risk, they do offer higher returns than traditional methods like bonds, even stocks, which are similar risk, to be honest, to a degree, as these equity deals. But if you compare it to lending on real estate deals, in theory, lending is less risky. You have a security deed that says this person owes me this amount of money and he can't sell the property until he pays me what he owes me. That is lending. It's on a flat percent rate. And so we talk a lot about debt and equity. Debt is, if I'm a private capital lender who's giving you a debt loan at a flat, we'll just say 10%, and I lend you $100,000, then obviously you owe me $10,000 every single year in interest until that is paid back on whatever timeline we agree to. So if that's a year loan, you owe me $110,000 in a year, right? And you owe me that whether the deal performs well or performs poorly. That's lending. In the equity world, I owe you your ownership percentage. So if the deal outperforms expectations, I owe you more. If the deal does worse than expected, I owe you less. That is both good and bad compared to debt. In the debt space, if I buy a building for $2 million and sell it for $4 million, and I have a 10% loan with my lender doesn't get to share and participate in the upside on that deal. I get all that as the owner. And so there's pros and cons to both. The other thing you get as an equity owner is you are a true percent owner in the building. You are a part of the taxes in a good way. So as most of us know, you can depreciate real estate buildings. And so if you're a percent owner, you get your percentage of those depreciation benefits. And we're recording this in 2026. There was a law passed where 100% bonus depreciation is back in play. So we actively pursue that on our deals. We will go out, we'll get a cost segregation study. We will accelerate the depreciation on our buildings and get a higher tax benefit up front sooner on our buildings. It's one of the more powerful things in real estate. If used wisely, we can do whole episodes on that, and we probably will. But that adds an extra tax benefit that an equity partner investor gets that a debt partner does not get because they're not on title in the same way. So general partners do the work. They take on more risk. The LPs invest money. Their risk is limited to the amount of money they invested. And for that investment, they get a percent share of the profit and loss of the building. So how do LPs earn money? Well, we are buying a lot of times property that's under rented, under occupied. And our goal and mission is to get it leased up and make more money. So when that building is stabilized, as in I've got the tenants paying higher rent, we've got the building more occupied than it was when we purchased the building, now it's making cash flow. And when it makes cash flow, it distributes or it sends distributions to all of the members based on ownership percentage. So we typically do that quarterly. And so these investors get profit and loss and see how much money we made in revenue, what our expenses are, what our mortgage was, what the leftover cash flow was, and they get their percentage of that every single quarter. So they get that the whole time we own the building. And that's awesome. However, they make the majority of their money and make it really worth it when we sell the building or refinance, which we'll talk about later. But let's say that we sell the building. And back to the example, we buy a $2 million building. We make it worth $4 million. We just added a ton of value. We added a ton of profit when we go to sell that building. That is split up by ownership percentage. And the way that we do it is at sale. Let's say we bought it for $2 million. We had a loan for $1.5 million and we sell it for $4 million. $4 million, take off the broker fees and whatever else. We'll skip that for this example. And you pay off the $1.5 million mortgage, you got $2.5 million left. Well, we first distribute the original principal that everybody had in the deal back. And then for this example, let's say that was $800,000. So we give $800,000 back to the original capital partners. So their principal is back, safe and sound. 2.5 minus 800, man, I'm terrible at quick math, is 1.7 million. So take out that original principal, 800,000. There's 1.7 million in profit. That is going to be split up by ownership percentage. And so the general partners will hopefully do really well. Limited partners will hopefully do really well as well. So I've done this enough that I've developed a system. And typically what we're telling our capital partners is for every $100,000 you invest in our deals, you're going to make a minimum of 8% cash on the deal when it's stabilized. So that's about $8,000 a year split into quarterly distributions. So $2,000 a quarter. And as that building gets more and more stabilized and as rents rise and we get better at operating it, that number is going to start creeping towards 10 to 12% cash on cash return. So then, 10 to 12 grand a year. And that's good money. For people comparing it to the stock market, there's definitely some years where the stock market does that or better. But on average, stock market's doing 7-8%. If you look historically, you could argue that number, but we'll just say that for math. Doing very similar to the beginning of when we stabilized the building. So we can outpace that pretty quickly. That's cool. But I can go lend my money to fix and flippers and make 10, 12%. So why would I do this deal? Well, because the money's at the exit. And typically what we're telling our capital partners is, hey, if you invest $100,000 with us, you get that cash on cash flow along the way, 8, 10, 12%. But then when we go to sell the building, you're going to get what's called a equity multiple. And typically we are saying at least a 2x equity multiple. A lot of times a 2.5, maybe a 3x equity multiple is possible. Each property is a little bit different. And so what that means functionally is if you invest $100,000 with us, when we sell the building, and if we hit a 2x equity multiple, that means you get $200,000 handed back to you at close, which remember, $100,000 of that is your principal, $100,000 of that is the profit. So if you take that amount of money that they made, the $100,000 profit, plus the cash on cash return along the way of distributions, and divide that out amongst all the years, there's a fancy term in this world called IRR, internal rate of return. There's actually way fancier, more complicated words than that in this space. There's MIRR, ARR, all these other RRs. And honestly, we could get into the specifics and debate all those things. And maybe that's worth getting into at some point. But I find, at least for my average capital partner that I'm putting into my deals right now, they just want to know, how do I compare this return that you're telling me I'm I might get. Remember, there's no guarantees. This is an equity. We could lose money, right? How do I compare this to my other opportunities? How do I compare it to a bond? How do I compare it to going and buying a property myself? How do I compare it to putting my money in the S&P 500? So the IRR is an attempt to get a rate of return to compare. And when you take the example I just gave of 2xing someone's money in 3 to 5 years, and you give them a little bit of cash on cash along the way, typically you get a IRR of 18 to 25%. And I can show you the math. It's actually a pretty complicated formula. Your Google Sheets or Excel can do it really, really easily. But that is the kind of return that you can compare to standard things like stocks, et cetera. And that is a significantly higher number than these individuals can get on their own a lot of times. So those are the different numbers that we tell capital partners that we are projecting that they will get. Remember, never a guarantee. We're not promising anything. This is an equity. And the whole next episode, we're going to get into how to pitch this and discuss this with capital partners. So save that for next time. So they make a little money along the way. The serious money is at the exit. But one of the things that we do is the LLC Partnership Method. Our goal is really to go find 2 to 5 capital partners at most for these deals. And we are still raising money even today within our own network. These are people that I already know, that know me, that have met me. I'll get into next episode, the different profiles, avatars of people that we are working with. But in general, and this is actually important for SEC rules, which we'll get into, is they know me in some way, shape, or form before we start talking about capital. Part of the big reason that I only want to have 2 to 5 LPs per deal is communication. I want this to feel very relationship-based. I want this to feel personal. All these individuals know me. They have my cell phone number. They have my email address. They can text me. They can call me. They can email me. A lot of operators don't want that level of responsiveness from their capital partners. And I just rather be the boutique version, if you will, of some of the bigger shops. And so I'm okay. My capital partners calling me and texting me. And, I get to know them. I get to know their wives and their kids. And many of them, I've been to their houses and eaten meals with them in their home and at restaurants. And I think that's an important part of it. And I think people want to invest money with people like that they know, like, and trust, which we'll talk about next episode. So I want the communication to be really clean. So I want there to be less capital partners so I can communicate easier and better. Now, you may ask, what ownership percentage are we giving limited partners, capital partners in our deals? Well, that completely depends on every single deal. We do it a little bit differently every deal. How do we figure out that number? It's based on a couple factors. It's based on purchase price. As you could imagine, raising $100,000 into a $500,000 building is different than raising $100,000 into a $5 million project. And those should carry different ownership percentages based on how much total money is needed to purchase the building. So that's part of it. Other part of it is, and the reality of the situation is, the deal needs to make sense for the general partnership group, whether that's just you or me or multiple people. The juice needs to be worth the squeeze for us to want to go out and do the work on this property. And I take a big spreadsheet, do all the pro formas, get everything nice and tight, figure out how much money this building is going to make, how much it's going to make now, how much it's going to make when it's stabilized, how is it going to make when it's 3 to 5 years from now, what's it going to sell for, what's a very conservative number it might sell for, so we're not too optimistic. And if those things happen, what does our profit look like? And is this deal worth my time as an operator? But then also, if someone's going to go invest $100,000 with me, if I have an extra $100,000 lying around, do I want to invest it in my own deal? Does that deal sound exciting to me? And if that answer is yes, then I've gotten all the percentages right. And so that's really what we're looking for to make sure this deal makes sense for everybody. It can't just make sense for the GP, and it can't just make sense for the LP. It's got to make sense for all the parties for the deal to work. So let's compare what we do to a standard syndication model. So I'm sure you've all been advertised syndication models or seen people online raising money into them. Typically, they're buying one building, one large apartment complex, for example, and they're pooling people's money together to purchase that building. So that's what a syndication fund is, pooling people's money together. So how our model is slightly different. Yes, we are pooling individuals' money together. And so functionally on the back end with the paperwork, it can look very similar, which we'll talk about when we get to the SEC section here in a minute. However, I like to, when I'm talking to capital partners, kind of explain the difference between ours and what I would consider a standard multifamily syndication model, for example. So if the fund is going and buying a $70 million apartment complex, for example, and they need $30 million, which is what I'd guess that they need in a situation like that, then they are raising money from lots of individuals, potentially at least hundreds, if not potentially thousands. And they're raising money from some folks with $100,000. Some funds accept $25,000, $50,000 into the fund. And then some individuals in that fund may be much, much higher, 250, 500,000, maybe even $1 million. There's all different levels of raise. And so to make all that even, they do shares, no different than buying a stock. And so for your 100,000, you get X amount of shares in the total limited partner ownership percentage of the project. So typically they have much higher ownership percentage than what we are doing in our deals because, for example, they're buying a bigger deal. So they may give away 70% ownership to the limited partners, and then 30% is retained by the general partners who are running, finding, and managing the deal. That is historical industry standard. However, in the multifamily space, we've seen that even start to shift towards 80-20 to the limited partner group. Now, remember, though, if you invest $100,000, you're not getting 80% ownership in the building. You are getting a small percentage of shares of that entire larger building. So what's the downside there? There's a whole lot of different people. So none of those people get any real input in decision-making at all whatsoever. So no one's calling you to ask if they should refinance or sell or what timing is. You're certainly not getting personal updates from the operator themselves. You are getting quarterly newsletters, maybe a video here or there and some email updates, and that's really it. If you're concerned about the project, sophisticated groups have investor relations type people that will answer your phone, but they're multiple steps removed from the actual deal, and they're only kept updated on what's going on the deal by the general partner group. So it's a very different communication setup and cadence than what we try to offer. And I really lean into that and sell that through the process. One of the bad things about it being a shared type process is if that project has issues or needs more money, they can just go raise more money into the LP pool and potentially dilute your shares in that project. Now, there's a lot of caveats to this. This is a very difficult or complicated subject. I know that I'm intentionally simplifying it. And so not all syndication fundraisers are doing that. But the vast majority of them are actively avoiding that and or would not do that. But I know many investors who have been diluted in these funds before. And so it's definitely something that happens. One of the things that we talk to our limited partners about is I can never dilute or touch your percent share in the building. So if you own 5%, 10% for your $100,000, whatever the number is, you own that forever. If we need to raise more money, that's on us to go handle out of whatever percentage that we have. And the last piece on the difference between us and syndication funds is we try to be very, very simple. It's a partnership. You invest this amount of money, you get this ownership in the building, and you share in the profit and loss in the building. Syndication funds, whether they mean to or not, have added a lot of complexity over the years. If you go look at their pitch decks, there's all these different fancy numbers and calculations of how much money you might make. And they may have preferred returns and waterfalls and different amounts of money the general partners will make at different levels, depending on what metrics are hit, and all these other different things that do matter, but they just make the deal more and more complex for the standard limited partner, capital partner, if you're not a professional in that world, it can be very difficult to understand what's going on. And so we just prefer a much simpler version for our capital partners. And I'd recommend if you're trying to be an operator to do something very similar for your deal. So let's talk about rules and regulations. I know that's everyone's favorite topic, but like we're talking about, if you're doing debt, if you go get a DSCR loan and then you get some private individuals to give you more money in the form of debt with a flat interest rate, then don't worry as much about this part. However, if you are selling an equity position, if you are selling equity shares, then you are selling a security, like we already talked about. And that falls under SEC rules and regulations. So you should have at least basic understanding of what is going on in that space. Because if you do something that is in violation of those rules, the SEC does not care that you're new and are learning this stuff. They expect you to understand their rules and regulations and to follow them. And if you can't do that, then you honestly shouldn't be raising money into your deal from other people. Fortunately, though, if you spend a little bit of time on this, the rules are not that complicated and you can do a good job following them relatively easily. First is understand the difference between debt and equity, like we already talked about. Understand if you're selling equity, you are selling a security. For your first one or two properties, important distinction here is if you are raising money from someone that you have a close relationship with, like we did in our first deal, you don't necessarily have to go get an SEC securities attorney to write your first couple subscription agreements, private placement memorandums, and all those things. You can get away with a general operating agreement that governs how you handle the building. That being said, when you start branching out of your very immediate network and start getting into network or friend of friends and start getting a little beyond that, you 1000% need to find a good quality securities attorney, work with them to develop paperwork. And the good news is, if you're doing this deal to deal, you can absolutely kind of get some templated documents that you can use and make some slight tweaks to here and there to use over and over. And it's a lot less complicated than it used to be. When I first started in real estate, there was talks of securities attorneys charging 60 grand for this kind of stuff. That price seems to have gone down dramatically. And I've talked to multiple securities attorneys, and you can get this done from 10 to 15 grand and have your entire document stack done for your deal and feel safe and sound. So if you're raising money into a deal over 7 figures, that's just a line item you should expect and something that you should handle as part of getting the deal done. It just is what it is. It's important. It'll keep you safe. It'll keep your capital partners safe. It's something I feel strongly that you should do. Maybe a deal or two you get away without it if you have a very good relationship with those individuals. If it's a family friend, someone like that. But as you start getting a little farther outside your network, you 1000% need a securities attorney to help you with this paperwork. So there's 2 types of securities that we're doing here. There's a 506B and a 506C. A 506B is one that you can raise money into from both accredited and non-accredited investors. But an important distinction, if you set up a 506B or you file your deal as a 506B, you cannot advertise on social media in any way, shape, or form. So you cannot raise money from individuals that you don't already know in some capacity. Good news is you know more people than you think. We're going to talk about that next episode. You absolutely can raise money on your first many deals right directly in your own network. But if you do a 506B, you cannot raise equities and talk about it online and to strangers. You just can't do it. If you do a 506C, you can advertise for those online and to strangers. However, you can only work with accredited investors. Now, what does an accredited investor mean?
So there's actually very specific criteria that you should check if you're going to do a 506C. The good news is nowadays it is incredibly easy to check. There's websites that you can actually just plug your investors to, and they fill out some information and it tells them if they are accredited or not. So it's a heck of a lot easier than it used to be several years ago, which is great. But just loosely understanding the definitions is very important if you're going to be raising money in a 506C. So there's a couple criteria. There's wealth and income criteria. And so it's 1 million in net worth, and you just need to make one of these, or making 200,000 a year as an individual or 300,000 a year joint with your spouse. So that's the main criteria that most people think of. There is one other criteria. If you are a licensed investment advisor, so you've passed either a Series 7 or a Series 65 test, you don't need the income requirements to meet that definition. So let's talk about why do these even exist? Let's think practically, logically for a minute. So the goal of all this complicated accredited investor business is really, the point being is that if someone is an accredited investor, then in theory, they've made enough money in investments that they understand the basics of investments and they can't get taken advantage of with some kind of difficult equity situation. So the thought process being, if they are pitched your equity agreement or your equity partnership, however you have that set up, and they've reviewed your materials, they understand the deal, they can make a reasonably informed decision based on their background on if they want to invest their money with you. That is kind of the goal of this accredited versus non-accredited investor. And that's why if you're going to advertise online, the individuals that you put into your deals in a 506C have to be accredited. They have to understand what they are investing in to some degree. Now, as you can logically think about, just because you have money doesn't mean you completely understand real estate deals. But it's a good enough barrier that the SEC felt reasonable putting that in place. So just to wrap up that kind of SEC regulation period, just be really careful on social media. Do not try to raise money as equity online unless you are specifically a 506C and you're allowed to do that. And nothing wrong with going in and setting that up for your deals. That's currently not the route that we're doing. We have raised money into 506Cs for a standard syndication fund. Right now, we're raising money out of our network just through 506Bs, but you can absolutely go do that. So just some quick points about taking other people's money. If you are going to go out there and structure deals where you're taking private individuals' money as investments, you need to be very clear about how you're doing that and doing that correctly. First off, I strongly believe that you should value their investment. You should value their money that they have taken the trust and placed it into you and your deal. You should always value their money above your money. So it is more important that they do well than it is for you to do well. Now, if you design the deal right, then you guys should win together. On the lending side, I have absolutely lost money on flips and paid my lender back every single penny of money that they are owed. In fact, that's the way loans are designed. They don't share the upside or the downside in the deal. So if you are taking money on a loan from a private individual lender, or the same thing is true if you are taking money from a hard money lender, right? You agree to loan terms with that individual, and the bad news is if the property doesn't do well, you owe the full amount plus interest. But the good news, the other side of that coin, is if you absolutely hit a grand slam and crush it, you don't owe them the upside. You just owe them what you guys agreed to. So in lending, it's even more important that you make sure that you are paying every penny owed, because that's what you agreed to. Now, the way an equity deal works, and that's why it's a bit higher risk than debt, and it's very deal specific how risky it is the equity partner shares in the profit and loss of that deal. And so if the deal does hit a grand slam and crushes it, and we've had that happen where a deal made millions of dollars over what we thought it was going to make, the equity partners, the people that invested capital with you, they get to share in that upside. That is why people invest in equity deals 100%, because they know a certain amount of those deals are going to hit it big. Now, the other flip side of the coin is if you have an equity deal that doesn't go the way that you want it to, they may make less than what you projected they were going to make up front. And it's important to note everything that you told them in the pitch deck, you need to make sure it's very clear. Those are all projections. Those are pro formas. They are not guarantees. You are just making an educated guess on how the property will do based on your past experience and the market and everything else. And so it's important to know those are all predictions. And so there's a chance the property does worse than you predicted, but still makes them money. There's a chance it does even worse than that and you guys break even. And of course, there's a chance that the property does really bad and you guys both lose your money that you have invested into the deal. And that does happen. And it's something that is part of this business. No one likes it. It is part of doing an equity investment. So your job as the operator is to make sure you understand the deal, you have underwritten it thoroughly, you have the experience within the partnership to handle that level of deal. If you don't take other people's money in equity. And as the potential equity partner, you have the duty to do quality due diligence on the offering and make sure you understand what you're investing in, which can be complicated and a lot of work. And if I would recommend, if you're thinking about doing equity investments and you don't understand what you're investing in, do not do equity investments. Start with debt, understand real estate, even from the lender side. It doesn't mean you need to go swing hammers and be able to understand contractor budgets and understand the market rent perfectly in every city. But understand these deals well enough that you can look at somebody's deal they're offering you and be able to critically evaluate what that deal looks like. And we're going to try to do a lot of that in this channel, both on the podcast, but on the YouTube channel as well. I'm going to take offerings and just give ones that I don't even know on purpose and just give my opinion about how they've written up the offering and what's good and what's bad about it and what you should watch out for if you're investing in it. Because I think it's important to develop that skill to be able to critically evaluate a deal. So if you're taking other people's money, there's a couple other things that are important. I would say the number one thing that is important is communication. And I know you've heard that in 1,000 other different ways and leadership podcasts and different things over the years, but I learned this up front: communicate. It's just like anything else in business, but even more amplified because you have their money. And so when you do that and they hear from you, they get calmed down. If they don't hear from you for an extended period of time, then they're going to assume the worst. They're going to assume that the building isn't going well, you're not leasing it up, the construction is going over time and more expensive. They're going to assume everything is going wrong. But if you communicate to them, now they understand where the deal is at. And I highly, highly recommend communicating to them, even if things aren't going the way that you want to. In fact, I think it's even more important to over communicate with them when things are going tough. And they'll understand they're humans, you're human. Not every deal works perfectly. It's not saying the deal is totally sunk because in month 3, it hasn't hit your lease up goals, but that's still, you need to communicate that. And when I was new, one of my second deal struggled and we had a lot of difficulties. And your temptation in that scenario as the operator, the general partner, is to kind of like batten down the hatches, shelter in place, push through it. I was over there working really hard on getting the deal to where it needed to go, but I wasn't communicating that well enough to my LPs. I was kind of pushing hard and then hoping the deal was going to look better in a couple of weeks and I could tell them about it then. That's not what you should do. And I learned that. And thankfully I knew all my LPs on that deal fairly well. And I got that quality feedback from some of them that I could be communicating better. And I've worked really hard to change that in my practice. And through that experience, learned how important communication is. And hopefully you don't have to learn the hard way like I did, but over communicate. I promise you, no level of communication that is possible to you will feel like over communication to the LP. And along that line of thinking, what's I think even more important or a part of communication is clearly communicate what the expectations are. I just had an investor sign up a couple of weeks ago for 2 of our deals, and it was a multi-month process, to be honest, to get him ready and comfortable to invest in our deals. And we had met through different real estate groups and had been out to lunch and a couple different things before he pulled the trigger. And I was completely, fine with that process. But what I hope I did really well for him is, all the documents were super clear. He had questions. We went back and forth on the documents, made sure he felt comfortable with them before he signed them. And then once he signed them and his money was invested in the deal, I sent essentially an onboarding email that went through, even though he knew all the details of the deal. We had talked about that several months earlier as he was kind of looking at my different deals, trying to figure out which one he wanted to put his money into. So we had a good understanding of the deals, but I re-outlined for him the expectations of those 2 deals. Here's the projected numbers of how we think this deal is going to do. Here's the overall general plan for each deal. Most importantly, here's when I think this deal is going to start making you money, because we're doing a lot of economic value add stuff that's not stabilized from day one. So it's like, hey, I think this isn't going to make any money for the first year, but year 2 is going to start making money. Or sometimes in our deals, that's quarter 2, we think we'll be able to make our first distribution, quarter 3, quarter 4, whatever that is. We clearly communicate that to them. And I also started communicating to them, these are the exact months that we do distributions, and even down to the day that they should get their distribution. And so we always distribute on these certain months. It's just January, April, etc. And so if it was April, you should expect to get your distribution on April 15th. Unless April 15th is not a business day, then you get it the first business day following the 15th. So that's just how we set it up in our world, but it's very clear. He knows when to expect distributions. He also knows we predicted on each building when I think they will be able to start making distributions. And you better believe if it looks like I'm not going to hit those projections, he's going to know about it. The other thing that you should communicate to them is how often are they going to hear from you? And one of the things you need to do is ask them what are their expectations from you. Or do they want to hear from you once a week? Probably not, honestly. You think that they need that? They really don't. But what are they looking for? Are they looking for once a month? Are they looking for twice a month? Are they looking for only update me on major milestones? Make sure you understand what their expectations of you are, and then tell them what you typically do and align those 2 together until they make sense. And so typically what we tell our people, just so you know, is in the early stabilization period when we're doing rehab and construction and working on lease up, we aim to update them once a month. And then from there, that slowly starts, as things get more stable, that may end up typically becoming once a quarter along the time when distributions, they get a global update on the property. And so that's just what we do in the background. The other thing that we're really pushing hard and striving to do is we have built our own internal investor portal. They get a login to it. And anytime they can log in and like, oh, how much did I invest in that deal? And what's my ownership percentage? And it's just all there in the portal. So they can see their 100 grand invested for whatever amount ownership. And they can see down into the deal level detail. We have on there all the monthly profit and losses. They can click into and see the HUD. They can see different basic documentation on the deal there. And I'm having my bookkeeper upload that to that website every month around at the 15th of the month for the past month. And so they can see every single month how the building is doing, and they can log into that at any point that they're thinking about the deal and they want to check on it. And then they get an email update when that financial information is updated. So that's something that we actually just recently implemented. So you can do without that. Don't get intimidated by that level of expertise. But it was something we found really important to us, is the better service. We want to provide essentially a white glove service to our capital partners. And if we can do that, they're going to keep reinvesting their money with us, and they're going to tell their friends about us. And that's what we want, right? Okay, so pretty good episode. Hopefully that helped. Pretty comprehensive on raising capital. We're going to have one more about actually having those conversations with individuals, but I wanted to leave you guys with some homework. So what I want you to do is I want you to take a sample deal. So I want you to take a deal you're already kind of looking at. Maybe it's a deal you looked at last week that you're talking to the broker on, and you're thinking of offering on it. Even it doesn't have to be a deal you're going to go buy. And in fact, it probably won't be, and that's okay. But just ask yourself, hey, if I was going to buy this deal at whatever the price is, $1 million, 1.5, $2 million, whatever, estimate how much capital you'd have to raise to do that deal. So to raise that amount of money, how much ownership would you need to give the capital partners, the LPs, to make the deal make sense for them? And then if you gave them that amount of ownership as the general partner, with the ownership you have left, how much money is that deal going to make for you? And is it worth your time? And do those things align? Is it worth, is the deal make sense that a capital partner is going to be excited about it? And does the deal make sense for you to be excited about going out and purchasing it and doing all the work that comes with buying commercial real estate? And if those things make sense, you now have a deal that makes sense. And let's say the asking price on the deal is $1.5 million and you don't think it's worth that. Even if you could never convince the broker and the seller to take $1 million for it, but the deal makes sense at $1 million, play with these numbers like you got it under contract at $1 million, just so you get used to what it looks like to take a deal that actually makes sense and then take it to the capital partner part of the numbers. Until next time, we've got another one of these series coming out next week. Talk to you soon.